Accidentally. This video is called Ban Phones at School and Taxes on Investments. So in fall of 2024, we've got a trend going on, and that is, as stated here, at least 13 states have passed laws or enacted policies that ban or restrict students' use of cell phones in schools statewide, or recommend that local districts enact their own bans or restrictive policies. This is from Education Week. Many school districts are doing this. It's about time because cell phones are such a distraction in schools. Social media on cell phones creates a huge distraction, and the amount of data can feel overwhelming. The same is true of taxation. Some people are just so overwhelmed by taxes they ignore it. However, you need some basis of understanding when it comes to taxation on investments. So let's assume that Sally, our investor, has two investments. First of all, she has a 401k retirement plan. Secondly, she inherits 200 shares of Apple common stock. Her accountant tells her that her cost basis on the stock is $50 a share, the stock she inherited. And during the year, she sells 30 of the shares for $60 a share. So there's a gain. The calculation of the gain is $60 sales proceeds less the $50 cost basis is a $10 gain per share times 30 shares gets you $300 gain. In addition, Sally earned $100 in cash dividends on the Apple stock. So two investments. So what's the tax liability? Well, in the 401k plan, if Sally, who we assume in this example is 35 years old, leaves dollars invested in the 401k plan, she is not taxed on the income or profits until she withdraws the money in retirement, which allows people to accumulate a lot more money because there's not taxation along the way. It's only at the end. Sally does not pay taxes on dividends, interest, and capital gains on the 401k. What about the stock? Well, the $300 capital gain that we calculated on the prior slide and the $100 dividend increase Sally's taxable income. Let's assume that Sally's taxable gross wages, what she gets on her W-2, is $96,000. The investment activity increases her taxable income to $96,400. What about paying taxes? Well, if the tax rate is 25%, Sally's tax liability is going to be $96,400 taxable income times 25% tax rate equals $24,100 tax liability. And she pays that in one of two ways. The first way is through tax withholdings on her salary. You do this if you're a W-2 employee. If those withholdings aren't sufficient to pay her liability, she may have to pay additional taxes, write an additional check when she files her tax return. So the point here is that both the gain and the dividend get added to taxable income. So to wrap up, retirement plans are generally not taxable if you're saving for retirement. The taxation is deferred until you retire and take money out. And secondly, generally speaking, capital gains and dividends, cash dividends, increase your taxable income.